All right, the last adjustment we are going to discuss in grade 11 is the adjustment for merchandise inventory. And it's very, very easy to make. Okay? Now, at the end of the fiscal period, the merchandise inventory account must be adjusted because it contains the cost of the inventory that was on hand at the beginning of the fiscal period. We've never fixed it. So at the beginning, right now, at the end of the fiscal period, it has what the merchandise inventory figure was at the beginning of the fiscal period. Okay, so since then, we've had sales, we've made additional purchases. Okay, so it's changed. The merchandise inventory account must be adjusted so it contains the cost of the merchandise at the end of the fiscal period. So we're going to fix it. Now, this is the key point. Okay? This is the only adjustment that is not going to be recorded in the adjustment column of the worksheet. Okay? And it's going, I'm going to show you where it goes. All you really have to remember is old, new. Okay? That's the old merchandise inventory figure, the new inventory figure, and the new inventory figure again. So basically, I'm going to open up a worksheet for you. Nope. All right, so normally all of our adjustments go here, right? So that's not going to change. Like every other adjustment is going to be recorded in the adjustments column of the worksheet. Okay? Now, the only exception is the adjustment for merchandise inventory. The old figure, remember old, new. The old figure is going to go on the debit side of the income statement. Okay? So old and then new and then new again. So old, new. So the old figure, which is $60,000, and in the example, I believe it's $58,000. So it'll be 60, then 58, then 58. Okay? And that represents your adjusting entry. Okay? For merchandise inventory. Now, if you remember, when you have to make or close out your expenses first for a merchandising company when we're making your closing entries. And I'll tell you why. Remember, this is the old merchandise inventory figure, right? So it's going to be this, right here, 60,000, right? So what ends up happening is all this old merchandise inventory figure is going to get closed out with all the expenses, because remember, the expenses have a debit balance. So the old merchandise inventory figure is going to get closed out with all those expenses. So we're going to reduce it to 0. Okay? Now, so that account's going to go to 0. The next, when we close out the revenue, we're going to debit this merchandise inventory account, right? Because in our closing entry, because we're going to close out all the revenue which have credit balances. So when we do that, we're going to put the new merchandise inventory figure into our ledger account when we make that closing entry. So that's why you have to close the expenses first before you close revenue, because we want to get rid of that old merchandise inventory figure when we make our closing entries. And then we follow that up by closing out the new merchandise inventory figure. By doing that, we'll put the new merchandise inventory figure into our general ledger account. Okay, and what we'll be left with the new merchandise inventory figure on our balance sheet. Okay, let's see if there's anything else in the note I have to go over. All right, so again, When closing entries are made, the beginning inventory figure that appears in the debit section of the income statement will be closed out with all the expenses, and the new inventory figure that appears in the credit section of the income statement will be closed out with all the revenue accounts. Okay.